Hey traders, Desmond here from IronFX. Let me ask you something. Have you ever had a trade that was behaving perfectly fine and then out of nowhere a monster candle shows up, spikes you out, and 5 minutes later price drifts back like nothing happened? Right? That is usually not random. A lot of the biggest volatility is scheduled. It is news, it is data, right? It is central banks, and the traders who respect the calendar tend to keep their money longer. Right? So today we are going to build a simple habit. What are the key news events you should watch every single month? And how do you plan around them without turning your trading into a stressful guessing game? Here's the thing. Trading without a news calendar is like driving fast at night with your headlights off. You might be a good driver, right? You might have great reflexes, right? But if there is a sharp corner ahead and you cannot see it, you are relying on luck. The beauty of macro news is that most of those sharp corners are scheduled. So let me give you a monthly checklist you can actually use. First bucket, inflation data. Inflation is the heartbeat of interest rates, and interest rates are the gravity of currencies, gold, and stock indices. Every month, you want your eyes on consumer price index releases and the personal consumption expenditures inflation data in the United States. Right? You also want the major inflation prints out of the Euro area and the United Kingdom, because Euro and pound moves can spill into the whole market. Right? Why does this matter so much? Because if inflation stays hot, the market starts pricing higher rates for longer. If inflation cools down, the market starts pricing rate cuts sooner. That shift in expectations is where trends can change direction. Second bucket, labor market data. If inflation is the heartbeat, jobs are the oxygen. Right? The headline event traders know is non-farm payrolls in the United States, but do not ignore the unemployment rate and wage growth numbers, because wages feed inflation. Right? You will also see supporting employment data across the month, like job openings data, the private payrolls estimate from ADP, and similar labor reports in the United Kingdom, Canada, and Australia. Strong jobs usually tell the market the economy can handle tighter policy. Weak jobs usually bring rate cuts into view. And that is why you can see the dollar, gold, and indices swing hard around these releases. Third bucket, central banks. This is where retail traders often get it wrong, because they focus only on the rate decision. But the bigger mover is usually the guidance, the tone, the phrasing. The United States Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Reserve Bank of Australia, the Reserve Bank of New Zealand, and the Bank of Canada all have scheduled decisions and follow-up communications, right? Even when there is no decision that week, minutes and speeches can still move price. Think of central banks like the person holding the steering wheel. The market is constantly trying to guess where that wheel turns next. Now, beyond the big tree, there is a supporting cast that shapes the month. 1. Purchasing Managers Index data. These are early temperature checks on the economy. You will see manufacturing and services readings. And in the United States, you will often see the Institute for Supply Management versions that can move markets sharply. If Purchasing Managers Index data weakens for several months, traders start to price slower growth, and the whole narrative shifts. 2. Retail sales. Retail sales is the consumer. It is real spending, real demand, and confidence. If retail sales starts cracking, growth usually cracks after it, and central banks eventually respond. 3. Gross domestic product updates. Gross domestic product is not a monthly release, but you will see it regularly enough, sometimes in multiple versions like advanced, preliminary, and final. When it surprises, it can reset expectations quickly. And if you trade commodities, especially oil and gold, you have 2 extra lenses. For oil, pay attention to the monthly narrative pieces from the Organization of the Petroleum Exporting Countries and the International Energy Agency. Those reports influence how traders think about supply, demand, and the bigger trend. For gold, the key drivers tend to be inflation expectations, real yields, and Federal Reserve expectations. Right? So inflation data and central bank guidance matter more than most new gold traders realize. Let me make this practical with a quick example. Say you are watching gold. It has been grinding higher, clean trend, nice structure. Then you notice that the United States Consumer Price Index is tomorrow. Here's what that means in plain English. Consumer Price Index is like opening a pressure cooker. If the number comes in hotter than expected, yields can jump, the dollar can strengthen, and gold can drop fast. If the number comes in cooler, yields can ease, the dollar can soften, and gold can rip higher. So what is the pro move? If you are already in profit, you reduce risk before the release, or you accept wider noise and size down. If you are looking to enter, you wait for the number, then you trade the aftermath. You look for structure like a break and retest, a clear rejection candle, or momentum confirmation. Because trading into the release without a plan is how good ideas turn into bad execution. Now, here's a simple rhythm that helps you anticipate the month. Week 1 often brings the growth pulse with purchasing managers' index data, right, and early indicators that start building the narrative. Week 2 is often the inflation punch, where consumer price index tends to be a major volatility window. Week 3 often becomes the consumer and policy echo, with retail sales, minutes, and follow-up data that confirm or challenge the trend. Week 4 is often the positioning cleanup, where traders rebalance risk, and you may see moves that look technical but are actually driven by flows and positioning. Let us talk about the traps, because this is where many retail traders get punished. Trap 1 is trading the headline instead of trading the reaction. A number can look good and price still drops because the market already priced it in. Trap 2 is using stops that are too tight for news volatility. You can be right on direction and still get tagged out by the spike. Trap 3 is assuming spreads and execution behave normally. During top-tier releases, conditions can change fast. Plan for it. So here are the core principles I want you to keep. Principle 1, know the calendar before you fall in love with a setup. Principle 2, decide if you are an event trader or an after-event trader. Most retail traders should be after-event traders because it is cleaner, calmer, and more repeatable. Right. Principle 3, one good trade after news beats 3 stressful gambles during news. The real secret is you do not need the first move. You need the tradable move. Here is my hot take to close this out. Do not try to be a news sniper. Be a news engineer. Use news to know when volatility is likely. Use your technicals to decide where the trade makes sense. And use risk management to survive the noise. A simple routine. At the start of each month, scan the calendar and mark the major inflation releases, the major labor market releases, and the central bank events. Each week, check what is coming in the next 48 hours. If a top-tier event is ahead, be selective, reduce leverage, and avoid forcing trades. After the release, wait for structure and confirmation. Right, that is it for today. If you build this habit, you'll find your trading gets calmer and more intentional because you stop getting surprised by scheduled volatility. This is Desmond from IronFX. Trade smart, manage risk, and I will catch you in the next episode.